I know if you look at a price chart, a current price chart, arithmetic scale of gold or silver, you think, oh, wow, it's just gone ballistic. I got to take profits. Okay. The bigger context is totally different than what you see on that screen. The screen looks like, yeah, I've gone ballistic compared to the price action that prevailed over the last couple of years, which is more layered. In fact, there was a period just April, May, June, July, August where gold was dead sideways. Okay. But this chart's very informative. I'm possessed by it, okay? As a technician. This shows silver price on a logarithmic or ratio scale chart. So, I've shown the period in 79 and 80 where silver, after going up for several years, went vertical, okay? And then there's the period in 2010-11, the green arrow and the lines, where you've been going up for years, and then in the last 2 quarters, you went vertical, okay? We've been going up for years, just like those, okay? Not vertical, arm wrestling all the way, torturing people, monthly consolidation periods, corrections, all that stuff that goes with the normal arduous bull market. We argue that you're at the gate of going vertical. And forget momentum now. We'll get into that later, and the key trigger for this we'll get into in a second. Just looking at the price charts, a log scale. If you measure what happened in the last 6 months of that vertical move that peaked in 1980, that's the red up arrow with the 2 horizontals showing where it started and where it ended. 6 months, you went from like $8 to 50, okay? So we mark that distance on the log scale chart there, okay? Forget that. Now let's go to the 2010-11 period, where you also went up to the $50 level. And in the last 6 months there, between the green horizontal upper line and the green horizontal lower line, you went up X amount there. Okay, we mark that with the green arrow. Now, when we take those 2 arrows, the green arrow showing the logarithmic dimension of that move, 2011, and the red arrow to the 1980 peak, and move them over to the present. At the present price, if you go vertical, and I'll give you that argument in a minute, equaling the 1980 surge, 79-80 surge, you go up to $200 or so, logarithmically. And if you match the move from October 2010 to April 2011, where silver went from like 20 something to 50, silver's going over 100 to match that ratio scale over in the next handful of months. Okay. Now, what's going to cause this? Well, aside from the certain fundamental arguments and also the fact that silver ain't going to stop at a triple top, guys. Okay. If you want to sell at 50, go be my guest. You'll be buried, okay? The question then is, though, once we get through that silly nonsense level of 50, because frankly it is nonsense because it's so many years ago that in real dollar terms, factoring in the degradation in the real buying power of the US dollar, remember it doubles and almost doubles in quantity every decade. So it's a junior version of the Weimar, okay? Silver would be $200 just to match the 1980 high or something, some number like that. Okay, so silver's been suppressed. Gold's way above its 2011 high, way above its 1980 high. Copper's above its 2011 high, and yet silver's supposed to stay below it. $50. Oh yeah, right. Bet on that. Anyway. We're arguing that we're going to break out. And the key for the breakout now is not whether silver's in an uptrend or a downtrend, because it's already been going up for a couple years now, right? Okay, no question about it. Different manner of rise, but still rising constantly. What's going to cause it to go ballistic? That's simply every month, where is the price of silver, divide an ounce of silver into an ounce of gold, and express it as a percent, okay? If we go back to late 2019, and you see the surge into 2020 where silver beat gold on the upside. The black line went from under 0.9% up to 1.5 something percent. So a big percent move. That's like silver went from 15 to 30 during that time, and gold went up about $600, but silver doubled. Okay, so the spread outperformed. Silver outperformed gold. But since that high in actually early 2021, silver has been giving back relative value to gold. Okay, it actually dropped back under the 1% level early this year. And in a sense, you can see, shot up nicely now on the spread chart. Now, right now, the spread chart's above that downtrend, but we prefer that horizontal red line. This is the top chart again. Top
Got it
chart.
right here.
This is the spread itself, which is price versus price expressed as a percent. I want to break out over that red horizontal. That means getting the price of silver versus gold from where it is right now, which is 1.23% approximately, above 1.31%. Then that spread has a triple top breakout over a base that goes back about 2.5, 3 years.
Yep,
So
that's it.
technically important. Okay. Now, when we run momentum of the spread, which is the chart below, let's measure what it measures is each of those monthly spread closes in relationship to a 10-month moving average. It has the same triple top, except you're at it.
We were right there.
Yeah, momentum is over to the right, is that third hit on the red line.
3.
So momentum is at its triple top breakout, which usually occurs first. Momentum almost always will break out into a new trend direction prior to price. Okay. We closed right at it the end of yesterday, the end of the month. Okay. Now, it doesn't take much to break that momentum through, and it doesn't take much to actually break the spread chart through. It's the most important technical out there. And if you think silver and gold have been going, quote, vertical lately by looking at your arithmetic daily chart of the last year or something, you're wrong. You haven't even begun to see it yet. And I think it's about to happen because, again, momentum is back to that triple top. It ain't going to stop. And when it goes through, the spread will go through as well, in which case, set the clock. The next couple quarters could be meteoric, and silver may it will likely end up in a new price reality rather than this $20 to $50 range it's been in for 50 years. Okay.
Right.
Copper's above that range. Gold is well above that range. Silver's about to catch up.
Let's start by addressing the obvious. If you're just looking at a price chart of gold or silver right now, you might think we've already gone parabolic. You're staring at those vertical green candles and thinking, wow, that's ballistic. It can't go any higher, and I get it. That's what your arithmetic price chart is telling you. But charts lie, or rather they lie by omission, because the big picture, the long-term logarithmic view, tells an entirely different story. When you zoom out to a proper log scale chart, what looks like an explosive rise is actually just a normal breakout within a decades-long consolidation. Silver has been coiling like a spring since 1980. Gold has already blown past its old highs, copper's above its 2011 peak, and yet silver is still pretending it's 2010. The idea that $50 is some magical resistance level is nonsense. Adjust for the loss of purchasing power. Remember, the US dollar supply doubles roughly every decade, and the old $50 high is more like $200 in today's terms. That's the number the market will eventually gravitate toward once it shakes off 40 years of manipulation and neglect. Now, I'm not saying this is going to be a gentle ride. Silver bull markets are never gentle. They're violent, they're emotional, and they make millionaires and break nerves at the same time. If you weren't around for 1979 to 1980, imagine this. In the final 6 months of that move, silver went from $8 to 50. 6 months. That's more than a six-fold increase. Then again in 2010 to 2011, after years of grinding consolidation, silver doubled from $20-odd to 50 in just 2 quarters. When you take those historic moves and transpose them onto today's chart on a logarithmic scale, the math gets interesting. Match the 1979 to 80 surge, and silver pushes toward $200. Match the 2010 to 11 surge, and you're looking north of $100. Either way, once that breakout occurs, we're not talking about $35 or $40 silver anymore. That's ancient history. What's going to light the fuse? It's already there, quietly ticking under the surface. The technical trigger isn't the absolute price, it's the spread between gold and silver, measured as the price of 1 ounce of silver divided into 1 ounce of gold. Right now, that ratio sits around 1.23%. In normal bull markets, it moves to 2% or more. In the monster rallies like 1980 or 2011, it shoots toward 3.5% to 6%. Think about what that means. If gold stays flat around $4,000 and the ratio moves from 1.23% to 2%, that alone puts silver around $80. If gold itself continues higher, say to $6,000 or $8,000, which is well within historical bull market multiples, silver at 2% would land between $120 and $160. That's not wishful thinking, It's simply returning to the range we've seen 21 times in the last 50 years. And we're on the cusp of that breakout right now. On the spread chart, silver has been lagging gold since 2021, but it's clawed its way back up. The ratio broke its downtrend line earlier this year and now sits just below a triple top level around 1.31%. Once it closes above that, and we're within spitting distance, it triggers what technicians call a spread breakout. Historically, that's when silver goes berserk. If you think gold's already moved a lot, wait until you see what silver does. When the spread breaks out, silver doesn't outperform because gold collapses. It outperforms because both metals rise, but silver rises faster. That's been true every single time in modern history. Now, for those of you who like your analysis with a little adrenaline, here's where momentum comes in. I run momentum studies on these spreads, specifically how the monthly silver/gold ratio behaves relative to its 10-month moving average. And the momentum chart is already kissing that same triple top. It's rare to see both price and momentum align like this. Momentum usually leads price, and right now it's screaming, we're about to break out. Once that breakout hits, you can mark your calendar. Over the next 2 or 3 quarters, silver's move could be meteoric, not just another leg higher, a regime shift. We're talking about breaking a half-century-old trading range between $20 and $50 and launching into a completely new reality.
Do you expect silver to ever come back down again, or is that it?
Yeah, well, it'll come down again, but it'll come down from a new reality. In other words, in both of those moves, if we further examine them, I don't have the charts here, but if you go back to that 79 to 80 surge at the tail end of that bull market that had been underway since 76 low, okay, in the last 6 months of that move, there was actually a correction in the middle of that move. And no
I can
doubt,
bring it up again if you want me to.
if you can, you won't be able to see that on the log scale, I don't think. Well, yeah, you could see it in 2008. There's an example there. You'll notice about 3 months after the green circle, where silver surged from just above 20, it surged up to over 30, okay? You had a bad month. No, the middle chart.
Middle chart right here.
The price chart. The middle one, silver, is the middle chart. That one there. 3 months later, you surged. Then you had a bad month in January of 2011, where you had a straight down month. 3 months after that spread breakout, you had a surge in price, but you had a bad month in January.
Yeah.
No doubt everybody thought, oh, that's it. It's a blow off and you're through. Then you turned, and the next 3 months, you went berserk. Okay.
Yeah,
Same thing happened in 79 to 80. There was a pause in the middle of the move, spanning about 5 to 6 weeks, where it looked like, oh, golly, it's topping. It was just taking a breath. And then it tacked on the rest. So it was the 3 months, wobble around, confuse, then get there. When you get to the new reality in silver, and it could be, my guess is it's going to at least be 100. It's quite probable, possibly could be 200. That's a new reality. No, that doesn't mean you're going to stay up there. You can have a sell-off, but you're not coming back to 50. Your sell-off might be from 200 to 125 or something. You're in a new reality on silver then. The key is participating in the move into that new reality. And I think it's not going to be one of these things where you get to casually judge it along the way, if you know what I mean. If you're not there, you're not there. Okay.
Right. So in your opinion that's the move you want, to get there for that move, and then you can
after that, who cares? I mean, you've done it, especially if you're using anything with any potency of leverage, with futures or call options, especially. Again, the key is that spread. And that's our primary technical focus week by week in our reports. In fact, we're going to put out an update this afternoon on that. And I break it down into a weekly situation as opposed to monthly closes, because we're pressing at the levels that are key. And if you can get through them, it begins.
Kitty bar the door.
Yeah, and you don't need a headline. The reasons are built into the market. There's decades of underpricing of silver relative to gold, decades of underpricing silver relative to anything, the value of the dollar, not versus other currencies, but its real buying power, et cetera, et cetera. It made a mistake. Investors did. They let it get underpriced for too long, and they thought, oh, that's the new reality. No. Yeah. It's just like, we see it with market tops sometimes. Like, you make a bubble top in a stock market and you think it's just going to go up forever. And it gets overpriced way too long. And when it corrects, it just doesn't correct. It collapses.
Now let's talk about what happens after ignition. Because once silver breaks above $50, the psychology of the entire market changes. For decades, that number has acted like a psychological wall. Every investor, every trader, every fund manager who lived through 2011 remembers it. $50 is like Mount Everest. It looks imposing until someone finally climbs it. Then suddenly everyone realizes it's climbable. Once silver clears that level, and it will, you can forget about resistance. There isn't any. In the 1980s, it went vertical from $8 to $50 in 6 months. In 2011, it doubled from $25 to $50 in 2 quarters. This time, when the breakout comes, the move could make both of those look tame. And it won't be driven by Reddit traders or silver squeeze memes. It'll be driven by systemic forces, sovereign accumulation, currency hedging, industrial shortages, and an institutional awakening to the failure of fiat. Now, that doesn't mean we won't see volatility. We will. Silver always corrects violently in the middle of its uptrend. In both 1980 and 2011, there was a sharp pullback mid-move that convinced everyone the rally was over. And then it exploded even higher. Expect that. Prepare for it. But don't mistake it for the end. This time, the new reality could be 100 to 200 silver dollars. When it corrects, it might pull back to $125, not $25. Think of it like tectonic plates. They grind for years, storing energy, then suddenly release it in a quake. You can't unshake the earth afterward. You just rebuild on a new foundation. That's what's happening in the monetary metals. So let's connect the dots. Gold has already been remonetized quietly by central banks. Silver's next. The US government recently reclassified silver as a critical mineral. That's a bureaucratic way of saying we can't live without it. It also means there's now an implicit floor under the price because it's considered essential to national security. At the same time, you've got nations building new gold vaulting networks across the global south. Hong Kong, Singapore, Dubai, Riyadh, St. Petersburg, all interconnected for trade settlement. That's the scaffolding of a post-dollar system. When you add silver's industrial role to that equation, the result is a market where monetary and physical demand converge for the first time in history. And it's not just Asia. Western institutions are starting to acknowledge this shift. When Morgan Stanley, Bank of America, and Jefferies start suggesting 20 to 25% gold allocations to their clients, that's not a trend. That's a repricing of how wealth is defined. If global asset managers, who collectively control over $100 trillion, even move 2% into metals, that's $2 trillion chasing a market with maybe $100 billion of freely available supply. Do the math. Prices won't just rise, they'll reset. And this brings us to the mining sector, the most asymmetric opportunity of all. Mining stocks have been the unloved stepchildren of the equity market for over a decade. But when you divide the XAU index by the price of gold, the ratio tells you the miners are still cheaper relative to gold than they've been in 40 years. Historically, that ratio oscillated around 25%. Today, it's barely 8%. That's a 200% to 300% upside just to get back to historical norms. The majors like Newmont, Agnico, Barrick, they've already started to move. Juniors are next. And when the juniors catch a bid, it's like lighting a fuse on a rocket. The best of them will see tenfold moves because the entire sector is so small. To put it in perspective, Apple's market cap is bigger than the entire global gold mining industry combined. So when institutional capital finally rotates in, it's going to feel like trying to pour a river through a straw. And that's exactly why these vertical phases happen. It's not greed, it's math and liquidity. Now let's look at the psychology again, because in every bull market, psychology drives the final leg. Right now, most investors are still in disbelief. They think this is a speculative spike. They're not looking at the underlying reality, that currencies are devaluing at record speed, debt is compounding faster than GDP, and every central bank is trapped between inflation and insolvency. There's no painless exit. When the market finally accepts that, gold and silver won't be speculative anymore. They'll be the only rational assets left. Even mainstream voices are starting to whisper it. Michael Hartnett from BOFI says a 25% gold allocation outperforms the classic 60-40 portfolio by 6% year-to-date. Chris Wood at Jefferies is calling for $6,600 gold. Jeffrey Gundlach, the so-called bond king, predicts $4,000 by year-end. When the high priests of paper start preaching gold, you know the paradigm has shifted. Meanwhile, back in the physical market, demand is overwhelming supply. Dealers who were overflowing with inventory a few months ago are now scrambling to restock. Shipping and insurance costs are rising, premiums are widening, and delivery times are stretching. This is with maybe 1% of the population paying attention. Imagine what happens when 10% wake up. If global allocations rise from 0.5% to even 5%, it's not just a bull market, it's a supply shock. The entire physical market could freeze for days or weeks as inventory disappears. And once that happens, the premiums will explode. People will look back and say, I can't believe I used to get Silver Eagles for $30. That's not fear-mongering. That's just market mechanics. And remember, this isn't just about price appreciation, it's about purchasing power preservation. The dollar has already lost 11% this year. M2 money supply is spiking again. Another 7% annualized growth. Your savings account yields 4%, while inflation quietly runs closer to 8%. You're losing at least 4% a year, guaranteed. Owning gold and silver isn't speculation anymore. It's insurance against arithmetic. And speaking of arithmetic, let's get back to those momentum charts. The momentum of the silver/gold spread, the very heartbeat of the precious metal complex, has now reached its triple top resistance. It's been building energy for years. Once that momentum line breaks through, history says silver will enter a period of explosive relative performance. You don't need headlines to spark it. The setup itself is enough. Markets move when imbalances become intolerable, and silver's underpricing is one of the most extreme in modern history. When that energy releases, you'll see what real velocity looks like. And I'll make one more point. This isn't about getting rich quick. It's about positioning yourself in front of a structural reset. When the dust settles, silver at $150 or $200 won't feel like a bubble. It'll feel like the new normal. At that point, yes, it'll correct, maybe down to $125. But the old world of $20 silver will be gone. The dollar will have eroded too much for those prices ever to return.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.